We're joined right now on RealAgriculture.com by Gordy Elliott. He is with INL FCStone. He's a commodity risk manager and he's based in Minneapolis. Welcome today, Gord.
Thank you very much. Happy to be here.
Hey, Gord, there is a lot of talk out there right now about the concern that we should have regarding fuel prices. Is this the kind of time right now or right before we get to the summer where farmers should start thinking about possibly doing some risk management on fuel prices?
Well, I believe that we still could be pretty bullish, but we've made the big move already. The position that we have may have been like a little bit of the horses out of the barn already, maybe out of the barnyard already, because we certainly have made a big move, and we're following what happened in 2008 very closely. If you look at what happened in 2008, by midsummer we dropped down to lower levels. I would only be interested in very short term what it takes to put a crop in, but not anything beyond that point in time.
So what we're hearing in more of the, I guess, the mainstream media is that we could see a pretty large move to our retail fuel. You're not expecting that at more of the industrial, like with diesel fuel at that level?
Oh, I think that's happened already, and I think it will be supported with the violence and the protests going on in the Middle East and Northern Africa. We are actually quite tight in diesel fuel globally, not so much here in North America, although we are starting to tighten our stocks, fundamentals, stocks that we look at. It's more of a global situation with a very active, lot of demand going into the eastern part of Asia's and what's happened in Japan with the loss of some refinery capacity, and also with what happens in Venezuela with confusion of how to run refinery systems down there has really given us in North America the opportunity to have very cheap crude oil, much cheaper than what happens in Brent crude oil, and therefore we have a good refinery margins. But as we look forward, we are selling diesel fuel at a world price, world market price, and that's kept our prices quite strong. And so we are paying that wholesale retail price based on those higher price levels that already has happened. And I'm not sure if the farmer would be would gain much by buying at this level very much. I would just be very cautious because of the similarity that we had about 2008, where we drove up eventually to $147 prices at that time, and then we turned and went much lower very quickly and dropped off.
So when we look at global supply of diesel fuel, how quickly can that supply increase?
The supply of diesel fuel globally can increase very quickly if you lose some kind of a market. And if we have too high of prices, which is perhaps where we're heading right now, what happened in 2008, energy prices got too high, and globally we went into a recession. We could look at those similarities that we have this year and do the same thing. I'm not saying we are going to do that, but there's speculation that we could enter that same mode. So that could quickly increase the supply. On the other side, though, if we have any further violence, refinery outages, some things, we could certainly hurt our supply and tighten the situation very quickly. It seems like we are in a neutral type position at this point in time here in North America.
Right, so when we look at commodity prices, you talked about 2008, things crashed quite substantially. Where does diesel fuel in 2011 fit it? If you think we're possibly at a point in the market where we've had the big run, how much downside is there to this market?
Well, we watch the market in the heating oil right now trading about $3.20 a gallon, 3.21, and at that time we dropped our market very quickly to a much lower pattern. And I probably should look at the daily chart so I can show you here. But we dropped from that year about 425 for heating oil down to 125 before we turn that market around. That's a substantial drop, and that's a kind of a drop I get concerned about. As we look at the cash markets and look at the NYMEX prices, we are following the 2008 curve almost within pennies at days as we're going back up. And so that's where we say we're very high. We're back to 2008 levels right now and climbing right along the same pattern.
Okay. So when we look at the 2008 curve, when did prices bottom out?
It was about the middle of summer and going into the fall when we really slid much lower. About time when your farmers are starting to do fall tillage and harvest actively. And so that's, in my mind, I would only look at the near-term needs today and let those deferred needs slide and wait to see what happens.
So what is kind of the outlook for something like diesel fuel? If we were to experience that same sort of pattern as we saw in 2008, is it what's kind of the prognosis for the rest of the year? Is it a potential climb back up, or is it really it's kind of a huge unknown at this point?
We continue to climb higher. Our interest rate structure is very cheap here in the States. And I think that's fueling some of the commodity issues we're having, along with a very cheap U.S. dollar. That cheap U.S. dollar certainly is fueling this issue. If the Fed, which are actually meeting today and will release some information tomorrow, would change that structure of what we had quantitative easing to a different program, perhaps cease it or stop, and we have the dollar turn and the stock markets drift lower, it could happen quicker than 2008.
Okay. Gordy, thanks a lot for joining us today, and we'll talk to you again in the future.
You're welcome.